priority ranking your investment strategy can be challenging. Where do you start? What do you do first? What is the order of operations here? This video is for you. I'm going to walk you through all of these things. But before we get started, let's first understand that building your investment strategy is like constructing a well-designed building. You have to have plans, you need a solid foundation. You can't just start throwing things together and expect it to stay upright. Like there's a process here. You need to create a process for yourself too. So I'm going to walk you through the 7 essential steps prioritizing your investments effectively, ensuring that your financial future is secure and aligned with your personal goals. So step number 1 is to invest in your 401k up to your employer match. So most employers will match your 401k contribution. It might be 2%, it might be 5%. Figure out what it is and put that much money into your 401k first and foremost before you do anything else, because that is just free money that your employer is giving you and it's going to be able to grow. I suggest that you automate this so that you're consistently investing in this every month or every year, however it is set up with your employer. The next thing you're going to do is you're going to pay off your high interest debt. It makes no sense for you to be investing in something that has a 10% return or a 12% return if you are paying 18% interest on your credit card, right? You're working backward, you're working against yourself, and you're actually getting yourself further in the hole by doing this. So the first thing you want to do is pay off your highest interest debt and then pay off all the other debts in order of interest rate, okay? So whichever one has the highest interest rate, pay that off first, regardless of the balance. And then once you're paid that off, take all the money you were paying into that and roll it into the next one. This is called the snowball effect. Eventually your debt will be paid off, okay? Number 3 is to save for an emergency fund. It's really, really important that you have money for a rainy day. Money when you have to replace the tires on your car. Money when your roof starts leaking. Money when you have a medical bill that was unexpected. Because you don't want to pull your money out of your investments for this, because you're going to get penalized. You're going to take a penalty or a hit on that. And it's going to set you back. So having an emergency fund is critical, and it's probably also going to help you sleep at night. Next thing you're going to do is max out your IRA. So our IRA is an individual retirement account, and it offers tax advantages that can significantly boost your retirement savings. Everyone's allowed to do this. So stay updated on your annual contribution limits, and I suggest you contribute that amount every year. Max it out every single year. Choose between a traditional or a Roth IRA. This might be based on your income. You might not qualify to do both, but also decide whether or not you want current or future tax savings. Next is to self-direct your IRA. A self-directed IRA provides flexibility and allows you to invest in a broader range of assets beyond standard stocks and bonds. So understand the rules here, because they come with specific regulations. So ensure that you are compliant, do your research, and this will just allow you, again, to diversify and explore alternative investments. So consider things like real estate, precious metals, private placements, which is where you can invest in like a small amount of a business or a small amount of a company or a real estate asset. Step 6 is to invest in alignment with your why. Investing in areas that resonate with your personal values and goals enhances satisfaction and commitment, which means you're going to stick to it, and it means you're going to work hard to achieve it. And this will accelerate your efforts and your returns. So make sure first that you identify your why. Reflect on what drives you. It might be sustainability, it might be innovation, it might be traveling with your friends and family. And then also look for research investments to look for the opportunities that align with your motivations. And step 7 is reinvest your earnings to build your wealth. So reinvesting your dividends, interest, and other earnings accelerates wealth accumulation through the power of compounding. So some tips here: set up automatic reinvestment. Most platforms allow you to automatically reinvest your returns, and just regularly review your investments to ensure that they remain aligned with your goals, okay? Anytime that you embark on an investment journey or any new journey, it can be challenging. You need to have a strategic approach. You need prioritized steps, and this is how you're gonna build your solid foundational, your financial foundation. So follow this guide. If you need help, reach out to me. You know where to find me. I look forward to hearing from you. Bye, guys.